Welcome to this explainer. If you've ever actually looked at a financial chart, you've probably felt completely overwhelmed by what looks like absolute chaos. We're talking jagged lines, erratic red and green spikes. Honestly, it looks a bit like a seismograph during a massive earthquake. But what if I told you that to a trained eye, all that chaos is actually a highly structured language? Well, today, we are officially opening up the trader's toolbox and demystifying 17 distinct strategies that folks use to decode the market. Okay, let's dive right into this, because it brings up the ultimate question, doesn't it? Can we mathematically predict the market? Is there truly order hiding inside all of that financial chaos? Now, obviously, nobody has a crystal ball, but over the decades, traders have developed some pretty fascinating visual and mathematical systems to try and tilt the odds in their favor. To keep our toolbox perfectly organized today, we're going to break things down into four neat categories. 1. Foundations of price action. 2. Chart and reversal patterns. 3. Advanced mathematical theories. And 4. Indicators and market volume. Starting off with Section 1, Foundations of Price Action. This is where we look at the very basic building blocks of market movement. If we strip away all the complex math, what we're really left with are two basic concepts: support, which is a historical price floor where buyers usually step in and take control, and resistance, which is a historical ceiling for sellers. But here's the catch. These aren't just rigid, static horizontal lines. Traders also use dynamic support and resistance. They rely on indicators like moving averages that act more like a flexible barrier flowing right alongside the price, rather than a solid brick wall. Now, when you string these floors and ceilings together, you get what's called market structure. An uptrend is essentially just a staircase of higher highs and higher lows, and we use trend lines to show that overall diagonal direction. But the real magic? That happens when the structure actually breaks. A break of structure, or BOS, powerfully smashes right through a previous peak to continue an ongoing trend. On the flip side, you have a change of character, a chach. This is absolutely crucial because it's your early warning sign. It's that very first lower low signaling a massive shift in momentum. And that momentum shift often leads us straight into supply and demand zones, which are sometimes called order blocks. Think about it like this. When the price absolutely explodes upward from a specific level, it leaves behind a demand zone. Traders believe heavy institutional buying happened there, so if the price ever falls back down to that exact zone, they want to be ready to buy. Conversely, a sudden, violent drop creates a supply zone for future selling. Moving right along to Section 2, Chart and Reversal Patterns, let's see how traders identify visual shapes to actually anticipate future moves. Over time, human psychology prints these highly recognizable shapes right onto the charts. Breakout patterns usually pop up when the market is consolidating. It's squeezing tighter and tighter into wedges or triangles until, boom, it explodes. Reversal patterns, on the other hand, like double tops or head and shoulders, happen when a trend is just totally exhausted. They help traders catch the exact moment the market pivots and goes the other way. So what happens during one of those massive breakout moves? Well, you often get what's called a fair value gap. This is literally an imbalance in buying and selling. It happens when a giant aggressive price candle forms, leaving a physical gap of empty space between the wicks of the surrounding candles. And traders view these fair value gaps as giant magnets. The running theory is that the market absolutely hates imbalance, so the price is highly likely to be magnetically pulled back down to fill that gap before continuing on its main journey. Now, most traders rely on traditional candlesticks to read exact real-time price action. They're hunting for shapes like a hammer to show rejection or a doji for neutrality, but for some folks, that's just way too noisy. That's where alternative charts come in. A style called Heiken Ashi smooths out the data to highlight strong trends, totally filtering out all those minor, distracting pullbacks. Renko charts go a whole step further and eliminate time entirely. A new block on a Renko chart only forms when the price moves a specific percentage, completely stripping away the messy noise of a choppy, slow market. It's a real game changer. All right, Section 3, Advanced Mathematical Theories. This is where we pull out the most complex tools in the toolbox, using geometry to forecast the future. The absolute cornerstone of mathematical trading is the Fibonacci retracement. Based on the golden ratio that we see literally everywhere in nature, traders apply this math to find natural pullback levels. It's pretty straightforward to use. You identify a major swing low and a swing high, you drag your tool between them, and then you just wait. You're waiting for the price to naturally retrace to a golden ratio, most notably the 0.382 level. A touch right at that level is considered a prime entry point to buy back into the trend. And what's really cool is how this Fibonacci math ties perfectly into Elliott wave theory. This theory proposes that markets don't move randomly at all, but rather in predictable 5-wave sequences driven by mass psychology. It has incredibly strict rules too. Wave 2 cannot pull back further than the start of wave 1. Wave 3, which is usually the big explosive move, has to be the longest wave, and wave 4 must stay above the peak of wave 1. Notice how beautifully these tools combine, though? When traders are looking for that wave 4 pullback, they're often waiting for it to bounce exactly off that 0.382 Fibonacci level we just talked about. Now, some traders take this geometry even further. Harmonic patterns use intricate combinations of those Fibonacci ratios to hunt for highly specific M shapes in the market. And they come with amazing names, by the way, like the bat, the butterfly, and the crab. Meanwhile, Gann angles use geometric fans based on a 45-degree angle. By drawing these radiating lines on a chart, traders can determine the strict structural strength of a trend. If the price stays within the steep angles, the trend is roaring. If it falls into the shallow angles, the trend is dying.
Okay, we have to talk about one of the most fascinating, unconventional theories in the whole toolbox, moon phase trading. I know, the premise sounds wild, but it's really intriguing. The idea is that if the moon affects the Earth's tides, it might also correlate with human emotion and mass market behavior. So, a new moon is considered bullish, bringing in fresh buying energy, while a full moon is bearish. Nowadays, it's mostly used with a sense of awe as just an extra confirmation tool, but it really proves just how deep this search for market order goes.
Finally, we arrive at Section 4, Indicators and Market Volume. Let's ground ourselves back in pure mathematical data. A super common mistake newer traders make is simply using the wrong mathematical indicator for the wrong environment. Momentum indicators, things like the MACD and moving averages, they're designed for trending markets. They reveal direction and force. But in a choppy, sideways market, they're going to generate false signals all day long. That's exactly when you need to switch over to oscillators, like the RSI or stochastics. Those shine by telling you when an asset is temporarily overbought and due for a drop, or oversold and due for a bounce. But no matter which indicator you're using, you absolutely must be on the lookout for divergences. A divergence is an incredible, secret early warning system. It happens when your indicator flat out disagrees with the real price movement. So the physical price is making higher highs, but your MACD indicator is making lower highs? Well, that's a bearish divergence. It means the momentum is quietly fading behind the scenes, signaling that a major reversal could be right around the corner. Here's the thing, though. An indicator is really only as good as the conviction behind it. And that brings us to volume. Volume verifies the absolute truth of a move. Standard price volume just shows you the pure amount of trading activity on a single candle. But advanced tools take this way further. The VWAP, or volume-weighted average price, calculates the ratio of price to total volume. It acts as a massive, dynamic support line, especially for institutional traders. Meanwhile, volume profiles completely flip the whole axis. Instead of showing volume by time at the bottom of the screen, they show volume by price level as horizontal bars. This highlights the exact price zones where the most intense battles between buyers and sellers happened historically. Wow, we have covered a tremendous amount of ground in this explainer today, haven't we? We've transformed those chaotic charts into a highly structured toolbox of 17 distinct strategies. We've looked at the foundational floors and ceilings of price action, the human psychology behind chart patterns, the advanced geometry of Fibonacci and Elliott waves, and finally, the hard grounding data of volume and momentum indicators. So, I want to leave you with this final thought today. Now that you know the hidden language of the charts, which tool are you going to reach for first to navigate the market's chaos?